Hello everyone, my name is Mohit. So today we are just going to represent the case study of corporate finance second. So in this project we are just going to share you the insights of risk and return analysis of Adani Enterprises. So me and my friend Sopning going to present overall the analysis of the corporate finance of Adani Enterprises. Let's continue this video. So, in this project, we analyze whether investors in Adani Enterprises are properly compensated for their risk they take. So, we study the company performance for financing year 2021 to 2025, focusing on risk and return behavior, systematic versus unsystematic risk, crisis comparison, and value at risk analysis. So, let's begin with the company background. So, talking about the company background, Adani Enterprises Limited, also known as AEN. So, the company of the Adani Group Financing Corporated, early it was mainly a commodities trading firm, but today it is become a diverse infrastructure and industrial company. The company operates in many sectors such as mining, energy, airports, logistics, data centers, and solar manufacturing. So, AEM working as a incubator, which means it develops new businesses and later may spin them off. Because of this model, the company has high growth potential but also face high risk and heavy capital expenditure. So, talking about the revenue model and capital structure, so Adani Enterprises earn revenue from multiple source because its diversified business model. Major revenue stream includes mining and coal trading, infrastructure services, solar module, manufacturing, and new energy projects. So, however, this model requires heavy investment. In terms of capital structure, the company has relatively high debt level. Debt to equity ratio is around 2.0. So being listed on an SE, it can raise equity when required. So it indicates an aggressive growth strategy supported by leverage. Talking about the key finance data. So looking at the recent financing indicators, so revenue is around 26708 crore, and net profit is recent quarter was 3396 crore, and market capitalization is approximately 2.9 lakh crore. That is such a huge, and ROE is around 9.78. So this number shows strong scale and growth, but return and moderate compared to high risk profile. So our main research question is, so, do investors in Adani Enterprises really get paid for the risk they take? Between 2020 and 2025, the company faced two major shocks: COVID 19 market crash, systematic risk; Hindenburg aggregation, unsystematic risk. So, interestingly, both caused similar stock crashes of around 46 to 52 point, but the recovery outcome was very different. This form the core of our analysis. Our major findings are: majority risk is company specified. Two similar crashes gave opposite return. Market risk reward investors. Governance risk punish investors. Mathematical model cannot put reputation shocks. So what was the recommendation for the Adani enterprises? So based on our analysis, we recommend investors should diversify. Do not hold this stock alone. So second, look beyond formulas. Check government's cognities. Third, treat government's crisis differently from the market crisis. Fourth, and not least, in government stocks, capital protection should be priority.
Now, I will explain the 5-year holding period return analysis. We calculated the HBR from FY21 to FY25. In FY21, after the COVID recovery, the stock delivered a massive return of 673%. This happened because markets bounced back strongly after the pandemic. In FY22, the stock continued to perform well and gave a return of 82.7%. In FY23, the return became negative at minus 14.5%, showing increased instability. In FY24, the stock rebounded again with a strong return of 86.2%. However, in FY25, the stock again showed a negative return of minus 28.8%. From these 5 years, we calculated an expected return of 159.8% and total volatility of 292%. This clearly shows that the stock offers very high returns but also carries extremely high risk. Now moving on to the next page, we have here here we divided total risk into systematic risk and unsystematic risk. First, in systematic risk, the beta value was around 1.1093, which means the stock is more volatile than the market. With this risk is market driven and cannot be diversified. Systematic risk was calculated as 55.05%. Next is unsystematic risk, which is company specific risk. This includes governance issues, management decisions, regulatory concerns, and investor perception. Unsystematic risk was 14.11%, which accounts for about 73% of total volatility. The key takeaway is that most of the stock's risk is company specific rather than market related. Further, we will move on to the next page where this is the most interesting part of our study. First, during the COVID crash in 2020, the stock was market wide. The stock price fell sharply, but the recovery was very fast. As a result, investors earned a return of 673%. This happened because COVID was a systematic risk and markets generally recover over time. Now, during the Hindenburg crisis in 2023, the shock was company specific. It raised concerns related to trust and governance. The recovery was only partial and the final return turned negative at minus 28.79%. So, even though the crash size was similar, the outcomes were very different. This shows that systematic risk recovers faster than company specific risks. Now, we will further move to the next page. Finally, here we calculated value at risk using Monte Carlo simulation with 10,000 replications. The current market price considered was 2,259 rupees. At 90% confidence level, the expected loss is 89 rupees. At 95% confidence level, the expected loss is 160 rupees. At 19% confidence level, the expected loss is 171 rupees. This tells investors the maximum expected daily loss under normal market conditions at different confidence levels. Thank you.
Our major findings are: majority risk is company specified. Two similar crashes gave opposite return. Market risk reward investors. Governance risk punish investors. Mathematical model cannot put reputation shocks. So what was the recommendation for the Adani enterprises? So based on our analysis, we recommend investors should diversify. Do not hold this stock alone. So second, look beyond formulas. Check government's cognitives. Third, treat government's crisis differently from the market crisis. Fourth, and not least, in government stocks, capital protection should be priority. So, concluding this presentation, so this case study provides us not all the risks are rewarded equally. Investors are usually compensated for taking systematic market risk, but they are not compensated for the company specific governance risk. Therefore, high return can sustainable on even corporate governance is strong. Thank you for giving your time. So, thanks.